All right, so pulling up for a live overview of what's going to happen in the FOMC meeting today. I think this will be fun. We'll get a chance to see Jerome do his thing, do a little skate around what we saw from the CPI, all that good stuff. My name is Paul Barron. Welcome back to the Tech Path. We're going to get it today. Obviously, you guys know Powell will jump on. He'll do his initial on the interest rate hike. We'll roll into his address. All that begins here in a few minutes at 2:30 Eastern. I think we're still, looks like we're almost getting ready to go live here. So we'll see. But there's a few things that you can expect from the Federal Reserve today. One of the things I think a lot of people have been talking about is the half-point interest rate hike that most likely will be the one that will come. There's no need for a point at this rate. Hike rates, of course, they might be, and this comes in from Tom Porcelli, who's kind of saying, yeah, this is most likely going to be the case. So, and I think this has been the scenario that we've talked about for last several weeks. Is the anticipation of the 50 has been on cue. Here's Darius Dale. Good morning. God bless. Time to focus on the next play. Dovish statement. This will be interesting. If he goes dovish, we will see a little bit of a market run. I think inline dot play, dot plot, hawkish. Jay, your thoughts on that, whether or not you guys think. Number 3, place close attention to the language he uses to accept or disregard the increasing evidence of material disinflation. This is something that Darius and I have talked about before at length. Make sure and check out some of our videos when I've had him and Dr. Bear on the show. Gareth comes in and says at 2, obviously we'll raise 50. That means nothing markets that factored in. Markets will react to the guidance on 1, future hikes obviously there, and then how long the Fed rates will have to stay high. That'll be the question mark for Q1 of next year, all that good stuff. You got a lot happening here on, here's Dr. Profit. All you need to know for today's rate increase. The more important part is the following speech. This is what we talk about all the time when Chair Powell comes on and starts talking about all that good stuff. So we'll definitely go into that. Make sure and drop some questions in. Smash the like button. It helps amplify this out to a lot of people that are really trying to understand how to play this market going forward, because this is a big deal. And I'll jump over to Bitcoin in a second just to see where the market is holding, because it was running pretty well there for a minute. And let's go to the charts. Hang on one second, guys, and we'll get right to it for you. All right, so you've got Bitcoin. It had that wick right there up to around 18.1-ish, and then wick has now since wick down here to almost 17.7, holding at the current 17.9808. And there's been a lot of volatility on this, so be on the watch for where Bitcoin and also Ethereum will be going. So lots happening here for sure, guys. Big moves potentially. Let me take a look here on ETH, and we'll get an ETH chart up for you guys as well, just to see how ETH's situation is rolling. Also kind of a wick down here at 13.15, but also nice run, not necessarily more so than what we saw on this spike yesterday, which was really a great time to, if you were doing some tax loss harvesting or you're doing some strategies like that, might have been a good one to go for sure. Looks good there. I think we're still waiting on Chair Powell to jump in. He should come on any minute now, and we'll make sure and get into that. A couple other things playing out in the Twitter Spaces side. If he is hawkish, we could see a sell-off of stocks today. They could accelerate into the end of the week. And this is, a lot of people have been kind of anticipating this, because this is one of the things that could play out in the market, especially through Q4 ending, being the last next 3 weeks, and really getting ready for the Q4 earnings from most of the S&P. Big tech is really one of the big factors, but also some of the service companies, industries, I think will have a big play into that because of the jobs reports that continue to flow in, and especially the non-farm jobs. Remember, there was a growth in that, mostly in the hospitality space. So a lot of that factored into kind of that false job expectations of what we thought might see. Looks like he's getting ready to come on right now. Yeah, they're live in the room right now. Powell is not necessarily entered. We'll see how that goes here in a second. But as you guys know, here's Dr. Jeff Ross saying with less 24 hours before the Fed's next rate hike, 50 U.S. 2-year Treasury yields setting at 4.2. Interesting. This suggests that the rate hike may be its last. This is interesting because there are some good factors here on how rate hikes can occur with the whole aspect of what might be looking on. So you've got the Fed hike applying to this. You've got the 2-year Treasury yield setting at 4.25, actually 4.225, and this could see, and we've talked about this earlier in the week, and that is the potential for softening. I don't know if I can hear that, guys. Are you getting it? There we go. Yeah, they just turned on mics. All right, so we'll kind of shut up here now so you guys can listen up.
Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path.
Oh, we don't like that.
Price pressures remain evident across a broad range of goods and services.
He wants more
Russia's
data.
war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite all of inflation, long-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched.
And he's just already leaning in on
The
this.
Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. Colleagues are acutely aware high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective.
Just not giving up.
At today's
2%
meeting, the committee
as a whole.
raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term and many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags which monetary policy affect economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is for 1% at the end of 2024, 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Right. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy has accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP again for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows that, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are soft.
We talked about this yesterday about a possible waffling of inflation data, meaning a little bit of a wave, which could affect them lengthwise.
The
in terms of a
SEP, like you
landing.
mentioned, suggests that the Fed will be making another 0.75 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough.
50-50.
I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE and core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market. One where we haven't seen much softening, where job growth is very high, where wages are very high.
I have a lot to say about that
are
on the
quite elevated,
we'll talk
and
about
really there's an imbalance in the labor market between
gonna
supply and
play
demand.
out
So
2023.
that part of it, which is the biggest
From the strength
part,
area.
is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're
biggest industry
expecting
that'll be
to go
affected
higher
there
and
is
higher for
restaurant and
time.
hospitality. So that's where a lot of the jobs came from, almost, I think, 236 on the
Howard
positive
Schneider with
side
Reuters.
for
Thanks for taking the
non-farm.
question. You described
a
GDP
big
growth in the
part of
SEPs
that,
as
too.
moderate
We'll get into
or
later.
modest, I believe. Yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So,
With
and you've got
exception
all
of
these
manufacturing.
vacancies out there, far in excess of the
What
number
they're
of
talking
people.
about is
That
the
doesn't
growth that
sound
we
like
saw in hospitality
a
and
labor market
restaurant-related
where
jobs.
A lot of people will
That
need
was
to
where
be
the
for that
numbers were.
So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick.
Thanks, Nick Temeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting, but what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's S&P?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel?
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the model suggests that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the media, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
It's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby?
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today, and as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
I think that sounds good, but I don't know that the data that's going to be rolling in here in January is going to allow that to happen.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just
playing
wondering,
both sides.
given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
And we're going into next year with higher inflation than we had thought.
I don't think so.
Right, so we're actually moving down to the level
remember
that
where
we're
the job
moving down
growth
to next
was.
year is still a very large drop in inflation from where inflation is
Mostly
running
in
now,
lower
well more
paying
than
jobs.
1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation.
So he's dropping some interesting
where's
things
it
in
coming
here,
from?
guys.
It's
So
coming
we'll do an
from-
analysis
it's coming from the
after
goods sector,
to give you a
clearly.
breakdown of, at least in my opinion,
By
where
the
this
middle of
might
next year, we
guide
should begin to
Bitcoin
see,
and crypto.
Lower inflation from the housing
Make sure and
services
smash the like
sector.
button if you like
And
these
then,
live streams like
the
this.
big question is how much will you see from the 55% of the index, which is the non-housing services sector, and that's where you need to see. We believe you need to see a better balancing of supply and demand in the labor market, so that you have. It's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you
Not gonna happen.
if you factor in productivity estimates, standard productivity estimates, wages are running well above what would be consistent with 2% inflation.
Yeah.
Neil.
It's interesting. He's really hanging a lot of this on the job side of things.
Some of your
So
colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. And we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. And China faces a reopening. They've backed away from their COVID restriction policies in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have some of the we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year, and this is the kind of reading that it will take to support that. So really this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline as long as new housing leases show declining inflation. That will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report. You don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that.
This
so we
was
don't put,
somewhat
we don't put,
expected yesterday in our
weight on
predictions
any one
video.
report. These things can be
And you
volatile
see the
month to
chart
month.
right
We'll be
now
looking
showing
for
about a
wages
2%
moving,
correction off that little
down to more
jump
normal
that we
levels
saw
where
here this morning
workers are
early
doing
as well.
And ultimately they're gaining
2% downward, almost 3%.
Michael, Kate.
There's Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So if I think I got your question. So, one thing is to say is I think our policies in getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient. We think sufficiently restrictive. We laid out today what our best estimates are to get there, it boils down to how long do we think this process is going to take. And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see.
We'll be taking some questions
prices
over
coming down.
on
We
the
understand
sidebar,
what will
so
happen.
make sure and drop those up
Housing
there. We'll try to get
services,
to some of
but
those for you.
the big
We're doing a
story
giveaway, by the
will
way,
be
at the end of the
rest
show,
it,
so
there's not
stay
much
tuned
progress
and
there,
around
that's
that.
gonna
We'll
take
do
some
an
time.
analysis
I think
afterwards
my view
as
and
well.
My colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports
I wish.
are
That would be
very
nice.
welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's inflation. 12-month core inflation is 6% CPI.
Actually,
that's
we
3
could
times our
probably
2%
pull a press pass in
target.
DC.
Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
Yeah,
No, I wouldn't say that.
transitory.
No, I don't say that. I mean, I would say this, to the extent we need to keep rates higher and keep them there for longer and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not. And if we do, whether it's going to be a deep one or not. It's not knowable. And certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of So I would put it this way, of a return to price stability that involves significantly less less of an increase in unemployment than would be expected given the historical record.
Ryan.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as it hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, I wonder how you describe that to Americans if the projections on unemployment find themselves. That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high.
You guys asked what I would ask. I would go into the aspect of jobs and the market segregation of jobs, because I think that's the real scenario that plays this out, especially in Q1.
In a episode,
I'll explain
50 years
here
ago.
in the end.
So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people, and so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions, and I wish there were a completely painless way to restore price stability. There isn't, and this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control.
You guys are keeping your spirits up in this market. I like that.
We're certainly highly committed to do that.
Grady.
We got a lot to say about this.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to.
Not yet.
It's,
he won't be thinking about it.
We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point.
Yeah. That's this time
but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
We'll give you some strategies I'm using for where this bottom might play out. You guys, if you follow our channel, you know a lot about that and where we do it.
As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level.
Yes,
how
we'll
do
get
you
over
factor potential
some of our
exacerbations
outlook
of
for
inequality
numbers
into your
in
risk
Q1.
calculation, especially given the K-shaped recovery in 2020?
So the
K-shape. Huh.
I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, has to be restored and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these potential exacerbations
Agree with that to a certain extent. If you compare, though,
yes,
in the last
we
30 years, even
absolutely
when
do.
Volcker
we look at
was in
it's
charge
a
of all
regular
this.
practice to talk about
The dynamics are a little
unemployment
bit
rates
different.
by different groups, including racial groups and that sort of thing. We keep our eye on that.
We got a poll coming, so make sure and participate. I don't know if the dump already happened.
Nancy
This was
Marshall-Genzer
a
with
small
Marketplace.
dump. If so,
What would
do we
you
got
do
here?
if the economy slows
This
so
little
much
dump
that
of,
we enter a
2.5%.
recession before we see strong,
2.5%.
consistent signs that
2.5.
inflation is slowing?
Right
In other
there.
words, stagflation.
You can kind of see it. Showing the wrong chart.
So I don't want to get into too many hypotheticals, but we'll.
There you go. That's your dump. That's your big dump.
It's hard to deal with hypotheticals.
2.5.
So
Right
let me
there.
just say that we have to use our tools to support maximum employment and price stability. I've made
This is on the
it clear
5-minute.
that right
We've been
now the
showing
labor
the
market's
5-minute
very,
chart.
very
You can kinda
strong.
see it
You're at near a 50-year
squeezing in.
low.
I mean, it's
You're
basically
at or
coming
above
right back in
maximum
here,
employment.
nesting into that space. You know, we're seeing a
50-year
little
low
bit
in
right there, but
unemployment.
nesting into that
Vacancies are
space
very
where
high,
it's been
wages,
holding
nominal
in
wages
that
are very high,
mid-17
so the labor market's
range.
very, very strong.
If even you go back
Where we're
out here,
missing
remember we had this
is on the
nice little
inflation
pop
side,
early in the week,
and we're missing by a
right
lot
here.
on the
So
inflation side. So
technically
that means we
down a
need to
little
really
bit. We go to the 4-hour,
focus
we'll show you a
on
little
getting
better,
inflation under control. And
you
that's
know, a
what we'll
different
do.
look
I
on
think
this
as
chart.
the economy
But
heals,
for now, we're on the
two-
5-minute,
two
mainly
points
because of
come
this
more into
effectiveness. I don't know that this
into
is going to
play.
play out
But
any
right
further
now,
on
clearly the focus
where
has to be
Bitcoin is going to
on
play here. This is kind of
getting
what we
inflation down.
expected yesterday, is kind of a moderate tone rather than dovish or hawkish. Some people could still say this is hawkish.
Greg Robb from Market
I'll
Watch.
explain
You
after
spoke a little bit ago,
the
you
announcement
said
here,
that
though.
the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that, talk a bit more about that? And really, are you talking about getting Congress action on increasing like legal immigration, things like that? Thank you.
So what I meant by that, the structural labor shortage, is if you look at where we are now, as I mentioned, if you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job.
But you have to break it down by
4
segment.
million
You have to break
people
it down by
short.
segments to really understand where the labor impact is coming from.
Despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually, it's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population.
One industry,
our labor force should
second
be
largest
3.5
industry
million,
in the United States, 16
more
million
than it is.
people.
And that, there
the
are
restaurant
lots of
industry
easy ways to get to bigger numbers
took
than that
a
if you go back a few more
$7 million,
years. So why
or
is
excuse
that?
me, a 7
Part of it
million
is just,
job right now.
accelerated retirements.
9
People
million
dropped
jobs.
out and aren't coming back
7
at a
million
higher rate
jobs
than expected.
in a
Part
period
of
of
it is
18
that we
months
lost a 500,000 people who would have been close to a 500,000 who would have
Think
been
about that.
working.
We'll get, because I'm going to
died from
explain
COVID.
that how, and why this plays
And part
plays
of it is
into
that migration
Q1
has been
and
lower.
Q2 next year.
We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in
Well,
my
the Fed's
in the
projections
speech I gave a
sometimes,
month
I
ago,
just
but
don't
but
know
stopped
that
short of-
he's reading
of
from the
telling
same
Congress
book
what to do because,
as everybody else.
They gave us a job, and we need to do that job.
Thanks. Jennifer?
Yeah, this is getting crazy. Crazy.
Thank you, Chair
As
Powell.
anticipated, though.
Jennifer
A little bit
Schonberger with
neutral
Yahoo
here.
Finance.
50 basis
you
points.
Say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No,
I don't think he wants to even
what we
accept
do is
that.
we make our forecasts and we publish them quarterly. And
All right, popping back to
if you look at those
17.9.
forecasts, those are forecasts for slow
Rolling
growth.
back in right now on 17.926. This is crazy. This is exactly what we anticipated. A little bit of sideways action, possibly a little bit of a run, as long as we didn't get a negative push.
Those are those forecasts, and
Which I feel like
that's
we've
really
got
what they
that.
show.
It's a kind of, this
We're
is
not,
more of a let's wait and see,
of
because
course,
January is going to be key.
We don't talk about this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things. But that's just upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
And we're not going
Jean
to.
for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course. That's something that we know and we'd see. But as I mentioned, we wouldn't. I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that it would mechanically happen like that. It'll be a test of. For cutting rates, I think in the event it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
All right, there you go, guys. That is Mr. Powell's statement. And there's a lot to unpack here for where this may be going. And you guys, hopefully you tuned in yesterday to our essentially our prediction of what might happen today. And pretty much everything came true. The 50 basis points hit. The neutral position is the other aspect of it. You got Darius Dale coming here, managed to convince all voting FOMC members to shrug off rather significant progress on disinflation in front. Yeah, okay. This represents incremental step forward in their hawkish reaction function. This, to me, I don't know. I would disagree with Darius. I know he would out-talk me on this. And probably have 15 algorithms to go against me with it in terms of data. But the point I look at are some of the fundamentals of why this might be a more neutral position. They've seen a fairly significant downturn in the CPI. We know that's happened. They've obviously rolled out with the 50. The 50 weren't going to adjust off of that, so that was pretty much predestined. The thing that plays into this, which I think is still very interesting to me, is their reliance on these job numbers that continue to show. Because remember, job numbers, I pulled something up quickly. This was the jobs report. This came from Yahoo News. Leisure and hospitality, one of the sectors hardest hit by the pandemic, continued its recovery with 35,000 jobs added during the month. However, the gain was only a fraction of September's 83,000 jobs increase. And the monthly average for the industry this year, this is one industry, guys. This is leisure and hospitality, restaurants, hotels, etc., bars, and so on. I get a chance to talk to a lot of executives in that space. There was a 236,000 job surplus so far year to date, which was really what offset those numbers for the the non-farm performance. The problem is that we saw the high-paying jobs, manufacturing jobs, professional jobs, all of those were flat. But leisure, hospitality were up. And here's the issue. Remember, and I said this earlier, the restaurant hospitality space lost 7 million jobs out of 16 million overall. 9 million was the result of that. Closures, restaurants could not operate. There was no business to be had. What restaurants stayed in and were able to still pay their employees, learned to operate their systems and grow out of this pandemic and the problems that we dealt during this last 3 years, and they've started to repopulate that original workforce, because that workforce is taking on a new set of demands from customers coming back into the marketplace. Here's the problem. Problem is that the food costs that have come out of, if you go back and look at the CPI numbers, food was the highest percentage of increase that we continue to see throughout this year. This is eventually going to hit a brick wall. And when that brick wall gets hit, that's when you're going to see the one shining star in labor get crushed. And let me tell you right now, restaurants are ruthless. Their margins are so thin and slim. Hospitality in general, hotels, all that. They have no choice but to cut jobs. That's going to happen from the biggest contributor of job growth. So this goes back to the Fed not even knowing how to read the data that's coming in from these places. And this is the concern I have of why I think the Fed continuously makes these slow errors of not reacting fast enough, not correcting the market. I agree that they're still pushing in the sense of that neutral position, a little bit, okay, we'll go Darius a little bit hawkish, but I would still say this is a neutral position because he's looking for an opportunity, but he's sticking to that 2%. And that is where I think the Fed is going to get sideways, and it probably is going to happen in Q3 of next year, meaning Fed will probably get into a position where they're going to see enough job loss in the market. They're going to see enough businesses close. They're going to see enough problems in the overall situation economically from the United States, which I think is going to be a big, big factor here globally. This is all going to play out in a global scheme. And then you're going to have a true recession. And that is when I think the Fed will call, put up the white flag, readjust to 3%, and then try to start targeting against that. If they can get down under the 5 to 6 range in the next 90 days, that will be a big achievement. When I say they, it's really the market self-correcting. The key here is I'm watching the restaurant industry the closest because this one is going to be the most impacted. Reason being is their price of increases on menu has started to affect their consumer sentiment. It's also started to affect their loyalty and their customer traffic. All of that plays into a trickle-down effect into jobs. No longer are those places available in terms of those new jobs. And if manufacturing doesn't pick up because we've got pressure here from companies not taking out loans to grow facilities, marketing, all those kind of things, you're not growing your market in any other place because you still have a continued high rate of interest for companies to grow their business. So this is a cataclysmic problem that is about to get in front of us in a big way. Now, we're going to have a couple of analysts on tomorrow that'll be breaking this down. There's one that I think is very interesting, and we've had them on before, Bad Crypto Charts. These guys go into, they're European based, and they really study what's happening in Europe, but also heavily into the United States around the Fed. And Patrick has a lot of interesting things to say about this, and there are some scenarios that could play out into a very, very cold, dark, traditional securities winter of where this might go in. So you see quiet mode now with less uncertainty coming in from me, Kevin. That's funny. He's hilarious. Next major catalyst right there. It's January 7th, labor report, and the January 12th CPI. CPI will be soft. Labor report, I think, will get a surprise, but it's not that one that I'm worried about. The one I'm worried about is February, because here's why. All right, holiday revenue, holiday sales will start to reflect by the time we hit February. And there will be job cuts. The big question is going to be February 1st, early February, and then early March. As we move into Q2, we'll start to see a bigger picture of real estate, the issue with jobs, which we've said all along, and the issue with just skyrocketing consumer credit, which is the other problem because people are relying on these credit cards now to live and to deal with the kind of cost raises that we've continued to see both at restaurants, grocery stores, all the things. Where we are seeing some adjustments are on the high ticket items, cars, watches, luxury goods. Some of those have started to come down. That, I think, has been the softening to a certain extent in the market. But if you look at Bitcoin, we'll go back to the chart here, it's starting to go a little sideways here. I want to go to the 4-hour just to show you how kind of nothing this was. Because right here was a little bit of our run. Remember, this is Monday. Right here, we're holding it around 16.9. And then we popped right up here to 18. That was our high. And then we're going to go sideways. So I'm looking at this range right here, probably in the mid 17, maybe 1.2. This is probably where that sideways is going to go. And if you look in here, see this zone right here that's playing out? This most likely is going to be the zone that plays out. Do we see this hold this position? That's the question mark. If I was playing this right now, which I am, and I look at Bitcoin, because I have certain long-term bags of Bitcoin and some Bitcoin that I use for trading on times like this, where, if you guys were following me a few weeks ago, let's go back over here. Let's see if I can zoom out on this. I hate it when we have these charts like this. Right here, we had that 15.6 low. This would have been a great place to go ahead and make a trade. Let's take a look at that right now if we were trading that. There's a nice 15%, guys. If you're not in that, if you're in this trade, take your profit right now. Just go ahead and pull the trigger. If you're setting on a ledger, go get it right now. Take your trade, make your profits. That's what I would do. And it's what I did and I'm doing this week. So I have Bitcoin, of course, I'm going to hold for a long time. I've got Ethereum kind of in that same position that is there. So I think this goes a little sideways for a while. We may see the dip right before the end of the year for tax loss harvesting scenarios that may play out next week and the week after. All of that's going to play into this for sure. We're going to take some questions. I know we have a poll. By the way, I want to show you guys one thing. We are doing, we have this 12-day program going on. If you are a CPI or mastermind member, we have this 12 days of blockchain. Those are the two first winners. We're giving $100 in Bitcoin to each one of our winners each day. So day 1 through all the way through 12. So Escopelletti, let's show that. He's on the mastermind group. We'll drop that in the private chat. You'll get $100. And R. Miranda, you're a CPI member. We're doing 6 and 6. 6 CPI members and 6 mastermind winners, members that will get $100 in Bitcoin that we're going to give away. So, just as a, it's kind of a holiday bonus to you guys for helping support the network. We appreciate that. Let's go over to our poll real quick. I want to see what the audience thought about all this bull. All right, here we go. Market 24 hours crashed, rallied. Boy, you guys are split on this. I love it, which tells me it's sideways. We'll see how it all plays out tomorrow morning. It's going to be a fun one. And I think there's a lot that rolls out through the end of the year. A lot of indicators that start to play into this, especially in housing, jobs, credit, all that playing into it, yet to really understand what's happening in Ukraine with Russia, that I think will also play out this. But early Q1, maybe some fireworks. Let's pay very close attention. So you got to be ready on these scenarios. We got a lot happening this week. We'll have a ton of interviews tomorrow. We got a new trader coming on the show. You guys are going to love him. We also have a deal with Invest Answers. James is coming on the show. We're going to talk all Solana and many other things about 2023 outlooks. And we have the Bad Crypto guys coming on from Bad Charts, I should say. These guys are really great on how they study charts. They have different dynamics. So all that's happening tomorrow. Then we have a big one, a big surprise for you on Friday. Should I tell them? Should I tell them, guys? You think we should tell them? I don't know. All right, well, we're going to tell you. We have heard that Mr. Richard Hart might be showing up on Friday. We'll see. If Richard, if you're listening, I know we've been talking. We'll see how it goes. We've got a lot to talk about because 2023 lays out some big things. And all you Hex guys out there, we put this up for vote too. It was kind of our own personal PBN DAO that was out there saying, should we go ahead and interview Richard? So anyway, we got a lot happening in the week. Make sure if you're not subscribed to the Diamond Circle, get in there right now. That's the first way to get some of those $100 Bitcoin freebies. And if you are not following me on Twitter, you got to do that. It's @Paul Barron. We'll catch you next time right here on TechBat.